Hello everybody, welcome back to the fourth lesson within our bootcamp. Now this is going to be a very key lesson inside of your development because this is going to be about time-based ranges. Okay, time-based ranges are going to be absolutely key for your development. If you don't understand them, then it's going to be very hard for you to develop, especially into the more advanced concepts. So for you to understand what a time-based range is, the easiest way to understand it is knowing what a candle is, right? Because a candle in itself is a time-based range, right? What is a time-based range? It consists of two time variables, that being an open and a close, right? So this can be, an hourly open, an hourly close, or a kill zone. I'll tell you what those are in a minute. Let's actually put these at an hour just to make it a bit more realistic here. Let's put this at 8 p.m. So that's an hour long, right? From 8 to 9 p.m. Now, on the price axes, there are, again, 4 points this time. There's an open on the price axes, a low, a high, and a close, right? So, those are kind of the 6 variables you need to understand when it comes to time-based ranges. Time-based open and close, price-based open and close, and high and low, okay? So, when we're drawing this out, these are going to be the 4 main things that we're going to be paying attention to. The high and the low. Okay? For now, these are going to be the 2 main variables that we're going to be paying attention to inside this specific lesson. Okay? So, that right there is a time-based range. Simply a period of trading within an open and a close on the time axis. So, what could we be utilizing as a time-based range? Okay? Let's first of all take the easiest and simplest one here. Let me get these lines off my chart. Let's take the very simplest one. And that being like, let's say, a daily high and low. Okay? Now, please do not get confused. On the daily candles are 6 to 6. Okay? This is not how the algorithm actually trades. The algorithm actually refers to days as midnight to midnight. So make sure you have that written down in your notes. So it goes midnight. Oops. I don't even have it selected there. Midnight to midnight. That right there is the true daily range. Okay? It does not go from 6 to 6. That is not how it moves, okay? The true daily range, the true daily open, is midnight to midnight. Okay? Don't get tricked by the daily candle. It's not how it actually moves. Midnight to midnight are the true daily opens. Now, I know market may open at 6 p.m. That's where you find your, daily new day opening gaps, etc. But that's how it actually moves. Okay? So now let's take, a daily range, for example. Our daily range would be the highest point within this midnight to midnight range, which is here. Whoops. Here. And then over to here. So this right here is our true daily candle. Now, of course, if you look at the daily chart, it will be a little bit different. Why? Because the daily chart is running off the candles from 6 to 6. Again, that's not how it prints. Okay. Do not get tricked by that. Now, why are these points important? Okay, these points will be extremely important inside the trading day and the trading day after that. Okay, so these specific points will get referenced to later on the day. So let's draw out the previous one as well here. Okay, there we are, midnight to midnight, midnight. Now, I'm going to draw out these lows and highs here as well. There's that low. There's that high. Okay. Now, what you'll be noticing is that after our new daily candle opens, which is right here on midnight, right? So this is where the sixth actually opens. This is the 5th, this is the 6th. After the 6th opens, 6th of November, right? What do? We leave that previous day's high, but then we drop lower. But this is very important, okay? We drop lower and we displace through that previous trading day's low, okay? That doesn't mean slowly trade through it. We rapidly trade through it, right? And we can tell that we rapidly traded through it by the formation of a fair value gap. What is a fair value gap? Fair value gap is a 3-candle formation, just like this, this, this. Okay, in fact, I'm actually going to make this middle candle a little bit bigger. Whoops. 3-candle formation where the first and third candle's wicks are not overlapping. Okay? So, as you can see, the wicks of these 2 candles here and here. So, the high of the first candle and the low of that third candle in a bullish fair value gap. That gap right there is our fair value gap. Okay? So this is basically showing us displacement, and a bearish fair value gap is literally just the opposite. So it'll be going down. Let's actually turn these black. It'll be going down, 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 and then we'll be referencing the high of that third candle and the low of that first candle here. Okay, and then the gap is right here in between them. So, now that we understand what a fair value gap is, what do you notice? We are seeing that displacement, we are seeing that fair value gap being formed inside of the leg of price that displaced through our previous day's low. Okay, so as you can see, fair value gap right here being formed. Okay, now what do you notice? We can see that after we traded through here, we came down lower, 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 and we started coming back up. Okay. Now pay attention to the bodies and the wicks according to the high of that fair value gap. Pay attention to that, right? The high of this gap, the wicks are piercing through, however the bodies are holding this. Same with the low. Okay? Pay attention to that. Wicks do the damage, bodies tell the story. If the wicks are doing the damage, they're piercing through, but the bodies are holding, the bodies are telling you what we're actually wanting to do. If we're holding the high of this, we're actually wanting to go lower. If we're holding the low of this, we're actually wanting to go higher, right? So if the bodies are closing above, but they're holding the low, that means that we're actually wanting to go higher. But look what we're paying. But look at what's happening. We are piercing through with the wicks, but we're closing below, and we're coming lower. And then we finally get that close out. We get the retest, and then that's when our drop lower happens. So really pay attention to the gaps that get formed when we're piercing through the high and low of certain time-based ranges. Okay. Whoops. Okay. Now let's go over a different type of time-based range. This basically being a kill zone, right? A session. Now, what I recommend for you to do is go into here and then search up ICT kill zones. And utilize this one. ICT kill zones and pivots by TFO, right? Now, mark down the times that these sessions are formed. New York AM is 9:30 to 11. New York lunch, it's 1 hour, 12 to 1. New York PM is 1:30 to 4, which is market close. And then pre-market, we've got Asia, 8 till midnight, and London, which is 2 to 5. Okay? Now again, these are going to be very, very important time-based ranges, because these kill zones are where our major moves will happen and where they're going to be sort of ignited. And the highs and lows of these sessions are again going to be extremely important. So, as you can see, during London, this is the low. Okay? London's high gets raided pretty much straight away. Keep running higher. So what's our next target? If London high gets raided, our next target's going to be London low. And now pay attention to what happened with London's low. London's low got made really, really close to Asia's low. However, it never took it out. Now, remember what I mentioned in our previous lecture. what is Ipda's number one sort of target, right? Ipda's target is to engineer liquidity, to get as many people into the wrong side as possible, but it leaves footprints of what it's doing. Now, when these liquidity pools are being formed awfully close to each other, this is a sign that we are engineering liquidity. What will happen? It will get raided later on in the day. Okay, especially when it's time-based liquidity, you really want to be paying attention to those specific time-based liquidity pools. So as we can see, we form our SMR up here, and then we start dropping down to London's low, Asia's low. Okay. Now, another very key concept is what happens when we raid these lows, and very specific candles that will be utilized. Okay. Now, after we close down below London's low and Asia's low, pay attention to this 5-minute candle that creates the low. Okay. In this instance, it was a 3 a.m. candle. I'm just going to draw this out in time. Okay. Let's paint that red. What you notice is after we close down below here, we never come back above this candle again. Now remember, okay, wicks are doing the damage, but the bodies are telling the story. The bodies are perfectly holding the low of that candle right there. How they're not closing above. Wicks, they can do whatever they want. Wicks are doing the damage. The bodies are telling us where we truly want to go. Okay. Now the same thing goes for the low of Asia. Okay. Now this one we do close above, but pay attention. Remember, we have 4 variables. We have the open, the high, the low, and the close. Let's pay attention to the close in this instance of this specific candle. Look at the bodies. Respecting the low of that specific candle, right? Really pay attention to those candles. Okay. So these are the main sort of time-based ranges I want you to be paying attention to. Sessions and highs and lows of the day. For intraday trading, this is what I highly recommend you do. Go to the 90-minute chart. Now, all you're going to be waiting to happen is a candle's low to form, right? So let's take this candle right here. You want a candle's low to get taken out. So this being the previous candle, okay? So when we're looking at this, we want it to look something like this, right? This candle's low is just about to close now, and now we have the high and low of this candle. Okay, so this is the previous candle because the new candle is about to print here. Now what we're going to do is we're going to wait for the next 90-minute candle to print. We're going to wait for it to print. Now pay attention to what happened here. A new 90-minute candle opens up, drops down lower below here, and look at the 5-minute candles. Do you see how they're respecting the low of that? Remember, the wicks are sweeping it, but the bodies are holding. That's what we want to be paying attention to. Now we're going to jump back up to the 90-minute chart. Oh, we're going to jump back up to the 90-minute chart after this candle is actually closed. When's the close of this one? 12, so it'll be around 1:30, right? Play it forward a little bit more. Okay, here we go. So this is the close of the that next 90-minute candle. And this is the open of our next 90-minute candle. Now, pay attention to that. This is the open of our New York PM, right? At 1:30. Now, what do you think the bias for this next candle is going to be? This whole next 90 minutes. For the whole next of 90 minutes, we're going to be paying attention to the high of that previous 90-minute candle, okay, that we marked out, right? So, if you pay this forward, as you can see, this gets blasted through. So, and then of course we raid New York AM because we raided the low. This is lunch, and then PM takes it out. So I'm going to be talking more about this later on in the bootcamp, but I really want you to be paying attention to these 90-minute candles because these 90-minute candles are also a very key player in what we need to be paying attention to. So again, let's recap on this. Open to close, right? So let's say daily range, midnight to midnight. I needed that to be very, very clear. If someone says that the daily range is 66, they are wrong. Okay, it's not. That's not how Ipda books price. It books price from midnight to midnight. Okay, that is the true daily range. Next, kill zones. Okay, hope you have the times for Asia, London, New York AM, lunch, PM. All of those kill zones are very, very key for you to be able to trade. We're going to be going over a few models that we can utilize and trade later on in time. But for now, I just want you to have those times in your mind. And I want you to sort of look back in price and watch how we react to these certain time-based ranges and levels. Especially the highs and lows of these ranges, because they are very, very key. Next I want you to be paying attention to is the 50% of these levels. Okay, so sorry, of these ranges. I want you to be seeing how we're reacting to 50% of this range, 50% of that range, right? And because again, depending on the range, we will react differently. Like let's take 50% of this range. Okay, we can see this is a very, very key reference point. Let's take this Asia. High to low. Again, we can see once we displace below it, we start acting as resistance on price. That's when we drop lower. Okay, 50% again is extremely important. Keep 50% of these ranges on your chart. I don't want to talk too much about them right now because I don't want to overload you with information. However, you having 50% of these charts and definitely looking into it will become very, very handy. It might even fast track you into lessons that we're going to be talking about later on in time. So, this was our sort of first key lesson on time-based ranges. So, hope you enjoyed and learned something new. I'll catch you in the next one. Goodbye.